All right, let's get into streaming and entertainment because Netflix seems to continue to stretch its lead over the group. Joining us, Tim Nollen is a senior U.S. media tech analyst at Macquarie Group. Tim, afternoon. Thanks for joining us on the Schwab Network.
Thanks for having me back.
Absolutely. Happy New Year to you. Netflix earnings this week. I mean, huge winner, right?
Yeah, it's kind of the quarter we were waiting for, I think. Kind of everything went right for Netflix in the quarter, didn't it? Right? I mean, big subscriber additions number, a turn toward positive ARM, or average revenue per member, ARPU, as most other industries or companies in the industry would call it. Revenue strong, operating income strong, increased guidance for operating income for the 2024 year that's now underway. So I'd say just kind of everything was rolling in its favor.
The fact that they're making money now at a better pace with advertising tiers as well. Is this the model that other companies in the sector should be trying to emulate?
They are, aren't they? And on Monday, we'll have Amazon Prime with ads coming, like it or not. I would say, and Disney Plus, of course, is expanding its ad offerings with more data, more tools to drive more targetability and higher pricing on its ads. What Netflix has done well has, I think, been they've tried to pair the introduction of the advertising tier, which arguably has actually not gone that well for them yet, but I still think it will, with this paid sharing plan. So cracking down on the password sharing that they had allowed and in fact encouraged to run rampant for a long time. If you look at the numbers, Netflix added 29 million subscribers worldwide in 2023. They have said previously that there are about 100 million password sharing accounts globally. So that's a lot more password sharers to still crack down on and roll onto a Netflix paid plan. Most of those paid sharing plans, so it's either you choose a paid sharing plan where you contribute more to the account owner, or what they're really trying to do is get people that have been riding their parents' accounts or whatever for all these years to sign up to their own plan, which they're trying to get them to sign to the advertising tier. That's a lower cost to the consumer, but it's a potentially higher ARM or ARPU, higher amount of revenue per customer to Netflix. And the larger the ad tier base, the larger the number of subscribers that are doing that, the more money they're going to make, and the more they're going to be able to offer their advertising slots to advertisers who want that reach, which Netflix, everyone assume, implicitly has because it's so popular. So those numbers are starting to move in the right direction for Netflix. Others like Disney Plus, others like Max, they are doing the same thing, trying to do the same thing. What's very interesting is Amazon Prime with ads coming to market now. Starting on Monday, I believe it is the 29th. Mm-hmm. They're doing the opposite approach, where rather than introducing an advertising tier for a lower price, they're simply saying, okay, all of you, however many tens of millions, hundreds of millions of Amazon Prime users, I forgot the number, you're all going to get ads unless you opt to pay more to avoid the ads. So that's very large ad inventory coming to market. That'll be a very interesting development to see what happens to availability of ads, to pricing of ads, and to Amazon Prime's ability to grow advertising revenue versus Netflix and others.
Great assessment on especially the kind of financial sweet spot that makes sense for the viewers, the users, and Netflix too. I guess that would suggest that the new additions might be a little stickier than perhaps in the past, that these are not just folks who like a certain piece of content or show that come on and leave. I mean, it sounds like this is a more sticky and stable cost for people based on what they're getting.
Yeah, it would be nice to have actual churn figures, which Netflix does not provide. But, we've seen third-party numbers indicating that Netflix's churn is much lower than most others. That probably also should not be a surprise. And I think what you're saying, Oliver, is basically you add someone on a lower price advertising-based tier, particularly someone that has been kicked off of their parents' account, for example, and has decided to come on themselves and pay for it themselves. Yes, there probably is a stickiness factor to that.
Okay. So going forward, what then can Netflix do to keep surprising? Because I feel like one of the big things here is just the level of surprise. Nobody really had that type of subscriber level in mind. What's the street underestimating? And then I want to get a few thoughts on the other names, so quickly on that one.
Yeah, well, it's been interesting watching Netflix the last several quarters. They've had as many negative surprises as positive surprises, actually. The positive surprises have picked up in the last 2 or 3 quarters, so maybe they're on the right trajectory, the right trend. I think, like I said, there is actually still more to be gained from converting the password sharers onto an advertising tier. I think the most interesting thing to watch for Netflix in the coming year will be updates on its advertising tier, which, as I indicated before, have not necessarily actually been hugely successful. We don't really have any real numbers from them. But what I think would be very interesting is if Netflix were to open up its effort to more third-party ad tech players, rather than relying on Microsoft, which, as we understand, gave them large guarantees for the first year or 2 years to be their exclusive service provider. Netflix may take more of this work in-house, and they may be successful with that, or they may look to other third-party providers in the ad tech landscape to bring more demand into buying Netflix ads. So I think that's probably the most important news bit to look for this coming year. And in my opinion, now my angle on Netflix is quite skewed toward what they're doing with advertising. It's my level of interest. But I think that's an important driver for them to see where they can really get that advertising base to, where they can drive ad revenues to, because that's really, as we said more than a year ago, it's really a 2025 revenue and earnings story for them from advertising. We're starting to get closer to that now.
Okay, great answer to that. Hey, real fast, Tim, what's the second best in the group? It seems like pretty much everything else connected to linear TV or advertising through streaming is a neutral in your rating.
Yeah, and even that's being kind
generous.
In a way. We're not too confident on the status of the traditional pay TV companies. We do have a neutral rating on Disney, by the way, but I think Disney is the most likely to succeed in the streaming world. They're in a little bit of a dearth of content right now, and they've in terms of the streaming services, more will be coming on in the coming year, and I think they will jumpstart their advertising effort as well. So we look to Disney's direct-to-consumer services to actually surpass their linear TV revenues this year in 2024. And then a few years out, it will take until they can actually generate some decent earnings to make that a profitable venture. But we think Disney, in its D2C efforts, will succeed. It's just that Disney has so many questions in front of it this coming year. You know, what's the final price of Hulu going to be? Are they going to divest some assets? What's that price going to be? And the big question is, when is ESPN really going to go over the top? We know it's coming. When is that going to happen? What impact is that going to have on the P&L? So Disney, we think will prevail, will succeed in the end. But there's so many questions in the near term.
All right, fantastic analysis. Thanks a lot, Tim. Really good stuff.
Thank you.
Helpful perspective for us to put the bow on Netflix for the week as a big winner.